Okay, good afternoon and welcome to the Compliance Dilemma Growth at What Cost webinar hosted by Vixio. My name is Jack Halliday and I'll be running the webinar. Before I hand over to today's moderator, Jimmie Franklin, I would just like to remind all attendees to please engage as much as possible by asking questions to our speakers. If you have any audio or visual issues or questions during the broadcast, please message in the chat box. I also want to remind you that today's session is being recorded and a full version of the recording will be sent out after the webinar. Without further ado, I'd like to hand over to today's speaker, Vixio Senior Journalist Jimmie Franklin. Over to you, Jimmie.
Thanks very much, Jack, and thanks so much everyone for joining us here today. We are going to be talking about how firms can match growth up with compliance costs, which is something that firms in the payments and e-money sector are having to continuously consider. What with the non-stop new rules that are coming out all the time, over the last few years, we've had PSD2, we've had the Consumer Duty, DORA, AML requirements, and soon we're also going to have the Instant Payments Regulation, and then the PSD3, and then the PSR. And I'm talking about the EU one, not the UK one there. Before we get started, though, I wanted to give you a bit of an introduction of what we do at Vixio. We are a RegTech company offering independent, authoritative, and actionable regulatory intelligence for compliance, regulatory strategy, and development professionals. We help you understand the impact and opportunities for your business so you can stay on top of regulatory change to meet your obligations and identify growth opportunities. And as for me, I'm Jimmie and I work as a senior journalist at on Vixio's editorial team, predominantly covering the UK and EU, and I'm very pleased to be joined here today by TrueLayer's Jack Wilson and Max Savoy, a partner at Sidley Austin law firm. If we can do some introductions quickly, that would be fantastic. So Jack, I'll start with you.
Hi there. I head up policy at TrueLayer. I've been at TrueLayer for 4 years, and prior to that I was implementing PSD2 at the Financial Conduct Authority for around 5 years, and prior to that I was at the Payment Systems Regulator when it was just getting started.
Brilliant. And Max?
Thanks, Jimmie. Yeah, I'm a partner at the law firm Sidley Austin. I focus on all things payments, particularly in the UK and the EU. Help firms across the sector, everything from small fintechs to big institutions to international payment systems, banks and non-banks, through the maze of regulatory requirements and reforms that we see in the payment sector.
Fantastic. So I think we're going to have quite an interesting discussion today. And please, everyone, as my colleague Jack said, do send in your questions and we'll do our best to answer them at the end of the session. Any that we are unable to answer, we can address post-recording as well. So with Vixio's report, which came out last year, we conducted a survey of 250 professionals in 5 key jurisdictions. These were pretty varied. We have the UK, the US, Germany, Brazil, and Australia. And our results have shown that compliance teams' top priority is growth. A vast 85% of respondents said that they felt pressured by their firms to increase risk appetite to support business growth. Yet, respondents tell us that they expect the compliance burden to increase. No surprises there. Jack and Max both did very good interviews for this report, and we'll be delving in a bit into what they had to say today. I'm going to start with you, Max. Given that we're seeing these regulatory proposals come up at the moment, which are keeping us all busy, how should firms plan ahead?
Yeah, it's a good question. And I think it's probably worth saying at the outset, growth is not a bad thing. It is not surprising or in any way worrying that firms in the sector are planning for growth. It's a good thing. Growth, competition, innovation, it's really the lifeblood of the payment sector. And you can imagine if you're an investor in one of these firms, of course you want to hear that the firm's going to grow. Now the difficulty, and maybe where there is starting to be a bit of a disconnect here, just based on the survey that Vixio has done and some of the conversations we've had on that, some of the conversations I've had with the FCA and others on this, is I think if firms are thinking grow at all cost, all about making the customer journey really simple, easy, and expanding and taking on new customers and launching new products at the expense of good, robust compliance policies, procedures, and resources, they are going to be out of kilter with certainly the FCA's expectations, and I would think a lot of other regulators around Europe's expectations as well. And just to to put a bit of meat on the bone there, I mean, we've seen already the FCA has been quite explicit with firms in the payment sector about what it thinks those firms' priorities should be. And it's written, a Dear CEO letter and various other communications, and said firms in the payment sector need to be prioritizing, not just paying attention to, but prioritizing consumer duty compliance, safeguarding and prudential rules, sort of safety, security, financial soundness, and anti-money laundering, financial crime, fraud. And that last one, I think, is particularly, I mean, they're all relevant, but I think that one's particularly pertinent when we have discussions about growth and customer onboarding. From some of my discussions with the FCA, I get the sense that there is a feeling that some firms in the market have been a bit too bullish in terms of seamless, smooth, easy customer onboarding processes, potentially at the expense of robust customer due diligence and anti-money laundering. So I'll pause there, but I think those are things to keep in mind.
Yeah, absolutely. I think I remember seeing quite an interesting webinar by the FCA last year where they were talking about sanctions, compliance and anti-money laundering. And I think we're seeing this as well with other regulators. I think the Netherlands, for example, did quite an interesting consultation recently on money laundering risks for the payment sector. So which elements of the payments industry do you think are being hit most by future regulatory burdens at the moment? Is there a particular area that you think is being hit a bit more than another, let's say?
Yeah, it's a good question as well. And I mean, you could kind of split the answer to that in different ways. You could divide up the sector in different ways. One, if you like, dividing line there, maybe dividing line's a bit of a strong word, but one sort of way of categorizing this and looking at where's an area where we've seen firms that are subject to a real ratcheting up of requirements over the last few years is non-bank payment service providers. Not to say that banks haven't become subject to more requirements, but I mean, if you look at, say, the course of the FCA's policies over the last few years, we've seen an expansion, an increased focus on safeguarding, which of course doesn't apply to banks. It does apply to EMIs, EIs. We've seen an expansion of the FCA's principles for business, now the consumer duty, to cover non-bank payment service providers. We've seen various additional conduct rules in the FCA handbook that used to apply only to banks, now being applied to EMIs and PIs. We've got proposals probably coming soon from the FCA to reform the safeguarding regime, potentially to have that more like a client money type regime that they apply to other types of regulated firms. And then we've got sort of looming on the horizon the possibility of introducing the senior managers certification regime to non-bank payment service providers. So there's definitely a direction of travel here, both in terms of regulation and in terms of supervision and focus towards a lot more. Non-bank payment service providers have become and have entered the spotlight, if you like, in regulatory terms. Now, that's kind of one way of splitting it. And another way would be to say, well, yeah, but that's maybe a slight oversimplification. Actually, the firms that are likely to see the greatest regulatory scrutiny and supervision are those who face consumers, and perhaps there's good reason for that. And you can certainly see that with things like the consumer duty, with some of the reforms proposed in the EU under PSD3. But again, it gets a little bit more complex, because if you take the consumer duty as an example, you actually get quite a lot of B2B payments businesses who end up being brought within scope of that because of distribution chains, because of how broadly retail market business is defined. So it's not totally clear cut. another sort of area to watch in terms of parts of the sector, being subject to more scrutiny. Certainly any firms that are involved either directly in crypto asset services or that are supporting firms that provide crypto asset services. I mean, the crypto asset service providers are going to become subject to a much broader range of regulatory requirements in the EU and the UK. And I think that has a knock-on effect for payment service providers, even if they're not providing those services directly. Some of those regulatory risks can attach to them. And then, another way of thinking, sorry, I know there's quite a few different ways of answering your question, but one sort of obvious way of saying, well, where do firms need to worry about, regulatory processes and changes? Well, any time a firm has to apply for a new authorization or a variation of its regulatory permissions. I'm sure a lot of people attending this webinar probably have some experience of interactions with the FCA on applications or on changes, and know how difficult that can be and how slow those processes can be. So anything, either because of regulatory reform or because of changes to your business model, where you're going to need additional approvals, that is becoming, I think, more and more challenging.
Well, there's a lot to unpack there, Max. I think as well, it's very much just how busy this year is going to be. I was thinking it would have a slightly quieter year with the elections coming up, so maybe not as many announcements, but it sounds like there is a lot in the pipeline and plenty that we can discuss in the webinar. I just wanted to follow up on the senior managers regime. I've not heard much about that for a while, and I wonder, is that something that should be I don't know, that people should be looking into if they're in the payments world at the moment? Is it something that we could see an announcement on?
Well, I'm not going to kind of crystal ball gaze, because I don't know. There have been various discussions over the last couple of years about whether the Treasury and the FCA working together are going to expand that regime. And so for people who aren't familiar with it, this is the slightly more prescriptive and detailed regime for senior managers and directors and other staff that currently applies to banks and investment firms and insurers and other kinds of regulated firms. Doesn't currently apply to e-money institutions or payment institutions. But e-money institutions and payment institutions do have governance requirements, and they do have rules about the appointment of directors and senior managers and the oversight of them, and the fact they have to be fit and proper. So to an extent, there's a matter of degree here. There's certain things which I think we've seen the FCA do already in increasing their focus on directors, on boards, on heads of compliance, those kinds of functions within e-money institutions and payment institutions. Now, some might argue the natural next step would be to apply the senior manager certification regime. I'm aware that there is a view within the FCA. I don't know if this is an official view, but there's certainly a sense that some of the differences between non-bank payment service providers and other regulated firms are a sort of product of history and the fact that the regime developed differently, and actually why do those things need to be different, and shouldn't they all be under the same umbrella, which is kind of what we saw with the consumer duty. But there's another line of thinking that these are quite different firms, they have different levels of risk. Actually, there are quite clear requirements on some of these things already. Why change it? So I don't know, but I do think it's something we should keep on the horizon. It's definitely a possibility we'll see governance and senior manager type reforms for non-bank PSPs.
No, definitely. I think that's a very interesting area, but I wait to see what happens next. And another thing that Vixio has recently seen an uptick in with regulatory activity is open banking in the UK. Obviously, we had the JROC report come out last year, and it seems like there is definitely a lot happening in terms of proposals and consultations taking place. I did an interview with the PSR relatively recently about open banking, and it does seem like it is very much a focus for them this year. And Jack, I know that TrueLayer has been involved in some of the JROC work. What are your thoughts on future open banking regulatory developments in the UK?
Well, yeah, 2024 isn't going to be a quiet year. And I'm speaking as not just an open banking provider, but we're also an electronic money institution. So it's kind of like a double whammy of regulatory developments for us. 2023 was this year of talking and discussions and working groups, encapsulated by this joint regulatory oversight committee structure. We were part of that. We led some of the working groups, especially around the development of a framework for variable recurring payments, because VRP, as it's shortened to, is this really important functionality for open banking. It bridges this gap and almost this barrier to entry that we have, where we want to compete with cards, but we're not functionally equivalent to cards. We can do single immediate payments, but we can't do recurring payments, so we can't match card on file and that kind of seamless process. So yeah, last year, a lot of talking. In fact, the minister, Andrew Griffiths, said 2023 would be the year of open banking delivery. It definitely wasn't. It was the open banking discussion year. So 2024 has to do something different, and it has to be about delivery. And it started with a bang. So the payment systems regulator has now consulted, or is running a call for views on very punchy proposals on a commercial framework for variable recurring payments. They've gone straight in and said, we propose to mandate it onto the 9 biggest banks, the CMA 9. We propose to set the price for PISPs at 0, because they say that the incremental costs are very low, because VRP is already there, it's already built for sweeping, which was done under the CMA order, and they proposed that this all happens via some kind of scheme, what they call a multilateral arrangement. So these are really big proposals, and that's coupled with this ambition to have a pilot in place for this next stage of VRP in Q3 2024. So really soon, this pilot would be looking at extending VRP to payments to government, payments to financial services, and payments to utility companies, all of these being regulated sectors and therefore low risk in the payment system regulators' mind. So this is all very ambitious, and it obviously starts the ball rolling really well for 2024. But there's huge challenges, because you need to agree what this commercial framework looks like. There'll be obviously winners and losers. The banks are not going to necessarily roll over when faced with 0 pricing structures. So we're in the first month of 2024, and we've got all of that to unpack. And the deadline to respond to that is this week, end of this week. So very busy. And then the next thing that we'll be looking at is Joe Garner at the end of last year published his vision for the future of UK payments, and basically set the ball rolling for the Treasury to publish an actual strategy, an actual roadmap for payments. And it happened to be on the 10-year anniversary that the previous Payment Council's strategy had been shelved, basically. So in the UK, we've always been without this North Star, this vision to get us to a place. And I think that shows, because you have a lot of different competing regulatory initiatives going on. You've got the payment systems regulator doing interventions for cards, open banking. You've got the FCA doing things, consumer duty. So how does all of this marry up and tie into a consolidated vision? So that's a really big gap that's now being addressed in 2024. So it'll be hugely important to see where that lands. And I think the Treasury is starting to have discussions with people about what they put into that strategy.
That's interesting, because I think Ireland at the moment also is consulting on a national payment strategy. So it'll be interesting to see whether the Treasury actually go ahead with that. Do you think, since JROG, just to follow up do you think that there has been more alignment between the regulators on open banking now? Because I remember that being one of the big complaints in the UK, that there was a little bit, work was occasionally a bit siloed.
I would say that they've managed to carve up the work into quite discrete packages, and they're each working on different packages. So the PSR has taken VRP as its project to enable, and that makes sense because it's part of the payment system regulators' 5-year strategy to increase competition in retail payments, and they see open banking as an enabler of that, and VRP is one step in the way, one step on the way to that, to the completion of that strategy. The FCA, even though it is the competent authority for payment services and open banking by that measure, has taken the discrete project of ensuring the successor to the open banking implementation entity. So it's been very busy looking into the governance and the funding structure, and how to transition from what we have now, which is the open banking implementation entity, to a body that can run the standard setting for open finance beyond open banking. So they're doing very different things. I'm sure they're talking to each other a lot more because of the JROC structure. But I think I would like to see the FCA talking more about the actual open banking payment side of things, because it's basically their baby. The FCA brought open banking into existence through the payment services regulations, and they authorize all of the open banking companies.
Absolutely. And how is the UK matching up to the EU at the moment in terms of the open banking proposals? Because I think in the PSR, at least when that was proposed last year, of the payment services regulation in the EU, there were quite a few suggested changes to try and improve open banking in the EU. So yeah, it'd be interesting to know how much you think the two jurisdictions are linking up, or kind of remaining aligned, or not.
Yeah, well, the EU certainly has stolen a march on the UK, and this is an obvious impact of Brexit. The EU has just soldiered on with the review that it was always going to do into PSD2, and did a huge piece of research, and developed all of these proposals to do a wholesale reform of PSD2, and now it has this payment services regulation and a directive. There's great things in there for open banking. It's bringing things out of technical standards and guidelines and putting them into the regulations so that they can ensure consistency across the EU. Consistency has been a real pain point for open banking companies in the EU. You go from one country to another, and open banking works differently. You get different levels of service, etc. So it's really good that they're focusing on consistency and standardization, and they're also looking at enforcement and compliance. So they're introducing things like fines for performance problems. So all really good, and there's a definite focus on enabling open banking through APIs, application programming interfaces, rather than screen scraping. So they're depreciating some of the screen scraping provisions. So in the EU, they've got this really forward-looking big reform of the regulations. In the UK, there's been kind of a vacuum post-Brexit. We've been waiting for the long-term regulatory framework to materialize. I would say that in the sense that they're looking at the payment services regulations in the UK is quite piecemeal. So they've been picking off bits. So the first thing they picked off was liability, because they needed to change those rules to enable the authorized push payment fraud rules. So there's been this big liability shift in the payment services regulations. They're now looking at putting a consultation out about safeguarding, as Max mentioned, and potentially moving that onto a CAS regime. The Treasury have been looking at slowing down payments, so going from D+1 to D+3, in order to combat fraud. So not really doing a big wholesale review and looking at how all of the pieces interact, but kind of looking at a piecemeal approach and trying to solve individual problems with individual changes. And I think that's going to have some unintended consequences. If you look at the authorized push payment fraud liability shift, for example, it's going to push a lot of risk onto the banks. It's going to result in the banks limiting more transactions, putting more friction to consumer journeys, blocking more transactions. This is not great for open banking. It's not going to be that catalyst for open banking that we need. So I think the sooner we can get to kind of a wholesale review and looking at how everything interacts, the better.
Yeah, absolutely. And just coming back to the EU payment legislation that's being planned out at the moment, how much progress do you think has been made so far, and how much can be made before the elections that are coming up in May, I think it is? Max, I wonder whether you can come in there.
Yeah, it's a good question. I suspect we will see, the FCA's consultation on safeguarding fairly soon, and that they will be pressing ahead with that. And I think based on some of the things the Treasury's put out before, there's a clear path towards that. What those rules will actually look like, difficult to know. I agree with Jack that, as compared to, say, the EU, where you have PSD3 and the regulation, and you have now a proposal for a financial data access regulation, which is going to really expand open banking into open finance, much broader range of financial services. In that sense, the UK is looking, but behind there. I suppose, if I were to take the, sort of UK government or FCA perspective here, they might say yes, but actually the EU legislative process takes a very long time, and that's built into the way that works, and we can be a bit more nimble now, so we can pick and choose. Now, I think Jack's right that can have unintended consequences sometimes when you don't align things. To try and answer your question a bit more directly, I mean, how much are we expecting to happen before the elections? I'd be surprised if we saw really kind of radical, detailed. I could be wrong. In fact, in some ways, I'd quite like to be proven wrong, but I'd be surprised if we saw really detailed, radical legislative changes before the next election. I suspect that there will be, and I certainly hope there will be, movement on some of the existing reforms in track, things that, like JROC and PSR and proposals and safeguarding from the FCA. But yeah, I'd be surprised if we saw anything really, really major that's new kind of coming in before the next election.
No, absolutely. And I just wanted to come back to the EU and UK safeguarding requirements, because they both seem to have made proposals, at least to, or the UK seems to be on its way to making proposals to overhaul the system slightly. How significant are these proposed changes in the EU and UK likely to be? I don't know if this is something that you're able to speak to, Max.
Yeah, so I mean, in one way, the sort of easy answer to the question is to say, well, most non-bank payment service providers are currently subject to safeguarding. Safeguarding rules are very tricky, and they've got trickier and trickier and trickier over the years as the FCA has refined and supplemented its guidance in its approach document, which many firms, the experience of many firms is that the FCA applies that guidance as if they are rules. So in one sense, you could say, well, because safeguarding is really difficult and because most non-banks have to deal with it, any change to that regime is going to be significant. I think it will depend a bit, of course, on what the changes are and on how a particular firm does its safeguarding. But if you look at sort of what we know so far, so in the EU, we've got the Payment Services Regulation, which is proposing, I think there's a requirement in there to require non-bank payment service providers to diversify the way they do safeguarding. We don't really know what that's going to mean or whether that's going to end up in the final text. But if that means that if you're an EMI in the EU or a PI in the EU, and you currently have a segregated bank account and that's it, that's all you've done, that's how you do your safeguarding, you may face a situation where that's not enough. Either you have to open new bank accounts with different banks, you have to get an insurer, you have to get some kind of comparable guarantee. So that could be quite significant. Now, from the UK perspective, again, I don't know what the FCA is going to put in its consultation paper, but what we're hearing is that there could be requirements that change the rules around how firms treat funds when they receive them, whether those have to be put straight into a separate safeguarding account rather than segregated maybe in an operational account, which is currently allowed. We could see changes around that the FCA has been talking and has in the past been pushing the idea that safeguarding should involve a statutory trust, which sounds all very sort of abstract and legalese, and okay, what's wrong with that? But anyone who knows a little bit about trust law knows that trusts involve various other things. They change the way you interact with counterparties. They involve fiduciary duties. So there's a whole load of things that could be tagged on, even to what might seem like quite small changes. So that's a long answer to the question. I think the short answer would be yes, I do think the changes are going to be significant, even if they're not a complete overhaul or a complete rewrite.
And are these changes in the EU and UK going to be, sorry to keep up with technical questions on safeguarding, but are they going to be significantly different from one another? Because it sounds like they are going to be slightly different regimes going forward once the UK starts.
I expect it's a really good question. I expect they will be. Why do I think they will be? Well, from what we've heard from the EU and the UK, they're already focusing on slightly different areas and talking about slightly different things. If you look at the bit in the Ghana report, the Future Payments Review report that Jack was referring to earlier, one of the sort of, one of the kind of areas as a theme, it wasn't safeguarding in particular, but one of the areas that was talking about is more principle-based regulation, maybe a bit more flexibility. I think the Treasury said something about that as well. So in terms of the style and the way those rules are set out, I do expect it will be quite different. I mean, if the FCA decides to move the rules in the guidance in its approach document and develop a much fuller set of rules and guidelines that look a bit more like its client assets source book, which doesn't apply to payments firms, I mean, that will almost inevitably involve some quite significant changes. If the EU more likely comes out with some quite broad provisions in the regulation along the lines of, you've got to diversify your safeguarding or you've got to do this in a slightly different way, then there'll be a whole load of regulatory guidelines and guidance and European Banking Authority questions and answers on that. So I can definitely foresee different paths being taken there.
No, the EBA Q&As tend to be some of our most read stories at Vixio, so I think people are always very intrigued.
Well, there's a good segue there back to something Jack was talking about earlier with open banking, and you've got these regulatory technical standards that set out the rules in the EU on dedicated interfaces and what that means and what you have to do, and those are quite detailed and quite prescriptive. But to really answer any difficult practical question, what do we have to do as a bank? What do we have to do as a PISP? You need to delve into those EBA opinions and additional guidance and additional Q&A. And that's pretty, even for someone who spends day in, day out doing that, it's hard. There's a lot out there and it's hard to remember what's out there and keep track of it all. So, I have a lot of sympathy for firms trying to navigate that. Having that all in one place would certainly make things easier.
I just wanted to comment on the safeguarding divergence potentially.
Yeah.
There's a question of what is the rationale for moving the UK onto a CAS regime. Is there evidence that the safeguarding regime is actually flawed? And if it's a case of the regulators have just not enforced safeguarding appropriately and they've been bad actors, that's not to say that the regime is flawed, because changing it to CAS is a huge change, as Max was saying. Is it just a case of intuitively the the UK regulators think that there should just be one regime and it should be CAS, or is there actually hard evidence that it should be changed because the safeguarding regime is flawed?
Can I try? And I think it's a really good question, and I don't purport to have all the answers to that. But my kind of sense from discussions with the FCA on that point is that, yeah, there is a sense, rightly or wrongly, I think, among FCA supervisors of non-bank payment service providers, there's definitely a perception that safeguarding doesn't always work. And the reason I think they have that perception is because there have been a few, not a lot, but a few failures of EMIs and payment institutions where the safeguarding rules haven't been properly followed. Again, I don't personally think that should taint the whole market by any means, but that perception is there, rightly or wrongly. And I think you're right, Jack. I think the other thing is there does seem to be this theme of, why are we regulating payments firms differently from other FCA authorized firms? Why don't we start trying to kind of harmonize this? We do this in a different way for other firms. Why don't we try and take some of the lessons from those? The danger, of course, as I think we can probably agree, is that that those CAS rules were not designed for payments firms. They were really designed for investment firms and firms dealing with sort of investment products and that kind of thing. Very different risks, very different ways of dealing with customer money. So I hope, and I do actually have, I'm going to be slightly optimistic here. I do think that the FCA understands that and understands that this can't just be a copy paste of CAS 7 apply all to payments firms, but it's going to be tricky, and I do worry there might be some unintended consequences to the changes.
No, absolutely, and I think I await that announcement from the FCA, where I'm sure that I'll be reaching out to you, Max, to comment on it at least. So yeah, one thing that I also wanted to touch upon that was quite a big theme last year with the FCA was, of course, the consumer duty, where again, I guess it kind of segues from safeguarding and bringing it into a similar regime to other areas of financial services. It was an area where payment suddenly was being treated the same as wealth management or investment services in a way that perhaps it hadn't been before by a piece of regulation, which I know caused people quite a lot of stress having to prepare to comply with a consumer duty, which I think was very new to different people. So I wondered, actually, do you expect the consumer duty to be or continue to be a big theme in the UK in 2024 after it being such a big issue with implementation last year? I don't know who wants to go first with that.
I'm happy to start. I'm happy to start on that one. In a word, yes. I know there's been, people are probably getting really bored of hearing from people like me about the consumer duty and its implementation and the rules and the deadlines, and it's like, well, it's here now, so why are we still worried about it? It is still the FCA's flagship policy. They've invested a lot of time, a lot of resource, and frankly, a lot of political capital into the consumer duty. They are expanding their supervisory teams to look specifically at consumer duty compliance. Firms across the payment sector, among others, are starting to get questions, questionnaires, requests for information from the FCA about their consumer duty compliance. And this is not unusual. When the FCA in the past has had big reforms, big new regimes, new sets of rules, they often do that. They often sort of give a lot of guidance, tell firms what they're expecting, give a little bit of time for firms to get their ducks in a row, and then start seeing, how you doing? Okay, let's check up on you. And then that starts to ramp up. And it sort of becomes okay, well, we've kind of, you've been fairly warned here. If you're not really taking this seriously and developing these and following through and applying this day to day rather than just putting a policy on the shelf, you're not doing enough. So I do think we will see ramping up of supervision around the consumer duty. I guess one of the other things I've heard from the FCA about the consumer duty in the payment sector is this is going to become part of the day-to-day supervision of payments firms, in the same way that, say, the FCA would always ask about safeguarding and wind down plans. I think the expectation now is they're always going to be asking about consumer duty compliance. So yes, I think this will continue to be a big theme.
Absolutely. And Jack, do you think the consumer duty will continue to be a big theme this year? And also, is there anything else that you expect from the FCA to be quite a big regulatory theme?
So consumer duty, it's already a lens that through which everything is looked at. I was part of this work over the summer to come up with the consumer protection aspects of a VRP framework, and the constant theme was, is this compatible with the consumer duty? How does the consumer duty interact with this idea? So it's ingrained in people's minds, and it will continue to be. It's not just one of those kind of rules that you can say for a rainy day. But to me, it does feel like there is this this big, I would say, the pendulum has swung towards consumer protection and almost absolving consumers from any responsibility. So authorized push payment fraud regulations, consumers will have refunds in all but exceptional circumstances. And even when they've acted with gross negligence, if they're vulnerable, they will still be able to get a refund. And that's great, right? So there has been a gap in protection, and people have lost out because of that. But where you are taking responsibility from one section, you are giving it to some other section. So the firms that are taking on this liability and this responsibility have a cost to bear, and that has this impact of creating barriers to entry. It will be much more expensive for firms to enter the market that has APP rules and the consumer duty and everything else. And I wonder if the regulators are thinking about that and looking at the pro-growth agenda that they had in 2017, where they had like lots and lots of firms entering the market, lots of innovation. They created the sandbox to cope with it. They created Innovate. And now they've kind of closed the drawbridge. Very few firms are getting through authorization and regulation. They've got all of these rules that piled on. So it doesn't seem like we're in that pro-growth phase that we were in before. I would almost say it's regulation at the cost of growth rather than growth at what costs. Yeah, so I think consumer duty and APP combined is going to make 2024 a really interesting year. Obviously, we're complying with all of those regulations, and we think they're really important. But it's what macro effect does it have on innovation and competition?
No, absolutely. I think that's the thing that I'm seeing throughout Europe as well. Like there does seem to be this push away from the interest in payments firms, and I don't know, like definitely the excitement that was previously there seems to have dissipated slightly from regulators. I do think it'd be good to discuss the PSR's app fraud reimbursement rules, because they are something that I have noticed come up quite a lot and have been writing about quite a lot the last year. And we have had a question in about it, so I think it'd be quite good to turn to that quickly. Max, I wonder, do you think like firms you're speaking to, are they seeming ready and prepared for quite big rules that will be coming in October?
There's definitely a big awareness that this is going to be a big thing for the sector, and I'm glad this is raised from someone in the audience. And by the way, this will be a big thing in the EU as well. Under the PSD3 PSR reforms, there's similar proposals around fraud liability. Whether firms are prepared, it's difficult because I don't think firms really have all the rules and the details to get prepared. I mean, they know, there's been, certainly we've got some, we've got some indication of what the standards might be, of where a payer's payment service provider might be liable, how liability may be allocated between the payee's payment service provider and the payers and what they're expected to do. But I don't think we really have enough for a firm to say, great, okay, let's build our policies and procedures to do this. What's our process when we get this claim or this sort of fraud claim from a customer? How do we deal with that? A lot of this is going to happen through the payment systems. A lot of this is going to happen through changes to, for example, faster payments and other interbank payment systems in order to actually make this work and operationalize it. So while I do think there's a healthy level of awareness in the sector that this is going to be big and important, we need to see more, really, before firms can actually start implementing and operationalizing this.
Absolutely. Jack, I don't know if you wanted to come in at all on that. Or...
Yeah, I mean, we're affected by this. We're an in-scope firm and a receiving PSP, and there is a big gap in the detail, like Max said. But there isn't any let up from the regulator. They're adamant that come October 2024, this will be in place, this regime. There will be liability shifts between the sending and the receiving PSP, but there is no standard way to communicate between the sending and the receiving PSP, and that's the big gap that needs to be built and standardized and operationalized. It needs, even when built, it needs people to sign up and participate, and there'll be a big long queue of firms trying to get into that system. And at the moment they're still, I think, looking at a vendor for the system, so it's really difficult to see how it will all be ready for October 2024. And if it's not ready, what will happen then? There'll be a lot of emails flying around between sending and receiving PSPs with demands to be reimbursed.
Oh God, it does sound like it's going to be very stressful. But yeah, I think it's definitely something that we'll be keeping an eye on at Vixio this year as well. One thing I did also want to touch upon, which is slightly more positive news actually, but the SPA scheme in the EU, the European Payments Council SPA scheme, because obviously TrueLayer was, I think, the first one to be authorized under the SPA scheme, and I think on the kind of open banking wave, it would be great to discuss what we should expect from SPA this year and how that could actually, beyond regulation, benefit open banking.
Yeah, this is another example of divergence between the EU and the UK. In the EU, the authorities basically entrusted the industry via the European Payments Council to come up with this commercial-led, the industry-led commercial model, to commission an PwC in the middle to come up with a price, and that price has now been published, which is a big achievement. That set that pricing schedule. And as one of the participants, I don't think any side, the supply or the demand side, was happy with the prices, so that probably indicates they're about right, but it's still experimental. We've got the pricing schedule, we've got the functionality, and we've got the adherence scheme, but there's only TPPs currently part of that scheme, and it needs banks to play. So until banks start to participate, until we've got a critical mass of banks, in fact, it's only an experiment, and it won't have demonstrated that industry can come up with a commercial model. And in the UK, we've jumped the gun. They could have let industry come up with a similar model and got an agency to come up with a price, and then waited for that experiment. But the PSR has gone straight in there with pricing proposals. So it's interesting to see how those two experiments will play out and what the outcomes will be.
Yeah, absolutely. So turning to some of the questions from the audience, we've had a real variety come in. Now, the first one, I think, links back a bit to the safeguarding proposals, but could one of you please explain CAS?
I'll try. Okay, so CAS, CAS stands for client assets, and it's the client assets source book, which is part of the FCA's handbook of rules and guidance. That's the technical answer. Doesn't really explain what it does. So that rule book is about the rules that apply to certain kinds of firms, not currently EMIs and PIs, but firms that provide, for example, investment services, firms that are holding or investing in, say, securities for their customers. They're generally going to be subject to CAS. Now, CAS has a range of rules, and part of that is about the protection and the safekeeping of securities and the sort of how are those protected, how are they registered, how do you make sure you know who owns what happens if a firm goes insolvent. Some of this kind of developed out of the Lehman Brothers and some of the sort of issues around custodians from the last financial crisis. And then you have, as part of that source book, something called CAS 7, Chapter 7 of CAS, which is about client money. And that's more relevant here. So those are the rules around those types of firms. I'm generalizing a bit, but say sort of investment firms, broker-dealers, securities firms, and what they have to do with money rather than securities, financial instruments. It is a much more detailed and prescriptive set of rules than the limited number of provisions we have in the payment services regulations and the money regulations about safeguarding. There are some very detailed requirements around reconciliation, governance processes. It's quite, it's worth having a look at that, I think, in the FCA handbook if you're not familiar with CAS, to get a sense of what might be coming. And then it has a sort of different starting point, which is that generally, unless you're a bank and you're holding money as a deposit, generally you're holding that customer money on trust for the customers, which, as I said, sounds like a legal nicety, but can have some quite important implications in practice.
Absolutely. And last but not least, I think we have one final question. It'd be good to know the difference between PSD3 PSR proposals on liability and the, sorry, I should stop saying PSR for the, okay, EU PSR and UK PSR. Now we have to do that. But it'd be good to know some of the differences with liability rules between the two, because I know that in the PSR in the EU, there were some proposals put out there on liability and reimbursement, and it'd be good to look at the differences between the UK and the EU's approach on that.
I would say the UK rules are very clear cut that it's 50-50 between the sending and receiving banks if there has been a scam, and scam is defined quite broadly, malicious payee or malicious redirection, etc. In the EU, there is this growing concern that because of the instant payment regulations coming in that are going to make instant payments more ubiquitous, there might be a growing problem of fraud, or of banks not being able to address the fraud quickly enough. So there have been some discussions, and it's part of the text, but it's very much more limited. I think it's still a world of buyer beware, basically, where most of the responsibility is on the consumer not to be negligent. And I think there is even this proposed provision where if somebody's been tricked twice, the second time they're liable because they shouldn't have been tricked twice. So it's gone nowhere near as far as the UK in terms of taking responsibility away from consumers. I don't know if I've captured that right, Max. Would you agree?
I agree with that. It's a really difficult question, actually, because you almost need to do a kind of line by line between what's in the proposed payment services regulation and the less defined, less detailed suggestions that we have in the UK. But I think that's right, and I think we know a bit more about what the EU regime may look like because, of course, we've got the text of that, at least the proposed text, set out in that regulation, proposed regulation, I should say. So we know, for example, on the EU side, there's some quite prescriptive rules proposed, which I think would be quite difficult, about the time frame that payment service providers have to investigate fraud claims and what they're allowed, what they can do before they have to give a refund. And if I remember correctly, I think it's only a 10 business day period is the sort of general time frame there. So that's going to be very tricky. So I think the expectation is going to be, it's going to be quite difficult. It's going to be quite difficult, frankly, to challenge fraud claims, even where you suspect that they may not be valid. And I think the general rule will be, a lot of refunds given out.
But that's compared to 5 days under the UK PSR rules, so it's even more difficult.
So it's more, yeah. And this is, again, it's a good point, Jack. And this is why you need to do that line by line review. So it's a really good question.
Oh, the complications of the UK-EU differences in regime that we have to deal with now. Now, I'm very conscious that we've only got 3 minutes left, and I wonder if I can quickly give this final question to one of you. Do you expect a requirement for CAS officer to be appointed as part of the proposed safeguarding changes? Max, is that something for you?
Oh, it's a really good question. If I had to hazard a guess, I would say I wouldn't be surprised if the FCA attaches some kind of governance arrangements, maybe something like that, to safeguarding, to the changes to safeguarding. Why do I think that? Well, they've already required firms to appoint a consumer duty champion. There's already sort of expectations that there'll be particular people responsible for certain rules, for example, having a money laundering reporting officer. So I wouldn't be surprised if in that theme of increasing, senior management director type responsibility, they do something similar. I don't know whether they will, but even if they don't, I'm pretty confident that you will see communications from the FCA along the lines of, dear CEO or dear firm, your board, your directors all need to look at this and take this seriously. This is not just a matter for the head of compliance. So I'm sure we will get that at the very least.
Interesting. Nice. Well, guys, it's been an absolute pleasure to speak to you both today. There seems to have been, well, there is plenty of stuff that we should expect this year. It feels like we're all going to be very busy. I'm going to pass back to my colleague, Jack, now. Jack, the floor is yours.
Thank you, Jimmy, and thank you to our speakers, Max and Jack. Thank you to our audience as well for attending and asking some really good questions. As mentioned at the start of the session, this webinar was recorded and the full video will be sent to all attendees in the coming days. Now, before we sign off, I just wanted to share some very exciting news. Next Monday and each Monday after that, on the first Monday of every month, Vixio will be hosting a LinkedIn Live broadcast. That will feature today's moderator, Jimmie Franklin, and Vixio's Senior Business Development Manager for Payments, Luke Baker. So be sure to join us at 2 p.m. Greenwich Mean Time or 9 a.m. Eastern Time on Vixio's LinkedIn page for a breakdown review of the biggest regulatory changes to the payments industry and what's happened over that month. Also, as you can see there, on the 5th of February, from the 5th to the 8th of February, Vixio will be exhibiting at ICE London. Should you want to speak to anyone in person, including our payments regulatory experts, be sure to visit our stand N10220. If you have any questions about anything discussed in today's webinar or would like further information, please email info@vixio.com or visit our website vixio.com for more information. Thank you.